Hello, I'd like to welcome everyone to this webinar co-hosted by the Group of 78 and Climate Legacy on Do Green Bonds Matter? I'd like to extend a particular warm welcome to our two distinguished guest speakers, Sara Alvarado and Mitchell Beer. My name is Roy Culpeper. I chair the Group of 78, and I am a member of the Steering Committee of Climate Legacy, which is a project of the Group of 78. Let me start by saying that I am grateful to live and work in Ottawa in the traditional, unceded, and unsurrendered territory of the Algonquin Anishinaabe people, from where I am making these introductory remarks. The Group of 78's and Climate Legacy's interest in green bonds arises from our concern about the impact, positive or negative, of finance on climate. Looking at its negative impact, we have held a webinar on the considerable investments of pension funds in fossil fuel production and the scope for divestment. We've also held a webinar on federal financing for fossil fuels, either directly or through subsidies, and the scope for change. Finance can also be a positive force by funding the transition to a decarbonized economy. We've held a webinar looking at community financing of renewable energy. We've also hosted webinars aimed at retail investors, particularly seniors with retirement or investment portfolios, who wish to ensure that their investments generate acceptable returns while doing good for the climate and the environment. Enter the green bond. Drumroll, a financial instrument that claims to support investments in climate-friendly projects. Now, green bonds are not new. In 2008, the World Bank launched its green bonds, the first of 164 issues, now worth more than $14.4 billion US. Since then, a number of multilateral bodies, including the multilateral development banks, for example, the African Development Bank, have issued their own green bonds. National and subnational governments have also gotten into the act. In March this year, the federal government launched its inaugural $5 billion issue of green bonds, which resulted in orders of over $11 billion in Canada. In Canada, the first green bond was actually issued by the province of Ontario in 2014. Our panel today will consider questions such as, do green bonds achieve what their proponents claim by supporting climate-friendly investments? What difference have they actually made to meeting current climate challenges? How can we know for sure? To what extent should retail investors concerned about the climate crisis include green bonds in their retirement portfolio? Should institutional investors such as pension funds invest a significant portion of their portfolios in green bonds as part of their climate strategy? And in a larger sense, what role could green bonds play in resolving the climate crisis? To tackle such complex questions, I'm delighted to introduce our two speakers, a leading expert in sustainable finance, but an enthusiast of green bonds, Sara Alvarado, and Mitchell Beer, a leading climate activist and someone who may be a bit skeptical about things and claims that are green, or said to be green. So Sara Alvarado is Executive Director, Institute for Sustainable Finance at Queen's University. She is former head of risk, Canada Infrastructure Bank. Prior to that, she was Senior Officer, Infrastructure, New Products and Special Transactions at the European Investment Bank based in Luxembourg. Before moving to the EU, Sara held positions at Manulife, Sun Life, and Scotia Capital. Sara is current co-chair of the World Economic Forum's Infrastructure 4.0 initiative. She is board member at Cambridge Memorial Hospital and holds an MBA from Edinburgh Business School. Mitchell Beer is publisher and managing editor of The Energy Mix, a new site and digest on climate change, energy, and the shift off carbon. He traces his background in renewable energy and energy efficiency to 1997, in climate change to 1997, and he delivered a TEDx Ottawa talk in October 2019 on how to build wider public demand for faster, deeper carbon cuts. A proud moment for Mitchell was building a model wind turbine out of wooden stir sticks with his then 11-year-old daughter. And I hope that model turbine did well during the recent windstorm in Ottawa, Mitchell. So, Sara, over to you first for 10 minutes of opening remarks.
Thanks so much, Roy, for the kind invitation to present on this important topic on green bonds. As you just mentioned, I worked at the EIB, and the EIB claims they were the first issuer of green bonds. They issued what was labeled in 2007 climate awareness bonds, and they have been a significant issuer, over 34 billion across 17 currencies. So a big issuer that is also, one of the yield curves in Europe for green bonds. What are green bonds, and how do they differ from other bonds? So just a quick recap on what is a bond. A bond is a debt instrument used to borrow money to raise funds. The funds are used, for corporate general purposes or for specific projects, such as is the case for project finance. So you have corporate finance, project finance, and then you have bond indentures that determine, the payment frequency, when do you get your principal back, interest rates, and so on. And you have credit ratings for the issuer of these bonds, which kind of link to the risk of ultimately getting the repayment on these instruments. Now, green bonds is a type of bond designed to raise funds to invest in environmental or climate change mitigation projects. Green bond issuers commit to provide investors with detailed ongoing information on the projects and infrastructure supported with the green bond proceeds. So use of proceeds from green bonds is tied and restricted to green investments only. Issue cannot freely go and use it other for what was intended. Now I'm going to talk about, what are the criteria and what they can be used for, which can be very broad. As I mentioned earlier, we had the IB with the climate awareness bonds in 2008. The World Bank that you mentioned, Roy, also issued in response to a group of Swedish pension funds who were looking to invest in projects that address climate change. And then we have issuers, in Canada, the provinces, and now Government of Canada, as was mentioned before. With the climate awareness bonds and the green bonds in general, the early ones became the blueprint for today's green bond market, providing options for investors to support climate solutions with their investments without sacrificing financial returns. And I want to emphasize on that because in our course at the ISF on sustainable finance, we have the desktop and the information about what is sustainability and the alphabet soup of all the acronyms. But at the end of each session, we have case scenarios where people are managing a portfolio and looking at how do I reduce my footprint at the same time that I maintain my returns? And how do you manage that? So it is very, very complex. So let's dig a little bit deeper into what are the criteria for green bonds. The use of proceeds, as I mentioned, is one. Proceeds are exclusively dedicated for legally documented green projects. There's a project evaluation and selection process whereby the issuer should clearly communicate the environmental objectives and the process used to determine that the project fits within eligible green project categories. The management of proceeds, the net proceeds of the green bond should be credited to an account for tracking and verification and reporting. The issuer must follow mandatory reporting on the use of proceeds to ensure the integrity of the market. Why are green bonds important? Climate change and drastic impacts that we have seen actually here in Canada with forest fires and floods and storms, and it's becoming closer to home every day. And our financial systems, it requires countries to transition towards smart low carbon economies over the next 2 decades, or risk their economies of being left behind. At the end of the day, if your economy is not clean and everyone is demanding green, clean projects, they are either going to be out of favor or you're not going to be as competitive. This rapid transition required to address climate change means a significant involvement of the financial markets in funding climate-friendly and clean projects. It is pretty much consensus that have the capacity and sufficient money to fund these things. So if you can bring the private sector investors, institutional investors, pension plans, and insurance companies to provide some of this capital, the formula works better. So green bonds are a barometer for the impacts of climate change on the financial system. The development of vibrant green bond markets allow countries and organizations to mobilize traditional debt investments into projects that can have a positive and environmentally friendly impact for society as a whole. So green bonds also give investors an opportunity to meet their environmental, social, and governance objectives by creating low carbon investments. A lot of people are looking at, how do I participate? How do I help in this process, this transition process? And green bonds, it is not 100% the solution, but it does help because it helps you channel funds. And I want to disclose my biases, and I'm an investor in green bonds in Canada. So what are the guidelines? And this is very important that we put attention to the guidelines because, as I said, depending on the specific green bond and the green bond framework, they could choose one or two or three or many of these eligible project criteria or categories. So to avoid the practice of using unsubstantiated or misleading claims to market a company or a product as environmentally friendly, the International Capital Markets Association, known as ICMA, created the green bond principle. So these are the guidelines, the principles, basically companies adhere to that and follow them. That was created in 2014. Regularly updated, the principles are voluntary and act as guidelines for labeling a bond as green. They serve as a starting point for issuers and investors in promoting and ensuring the integrity of the green bond label. The guidelines recommend transparency and disclosure of the use of proceeds of the bonds that investors can evaluate and environmental impact of their green bond investment. So eligible project categories, and I don't mean to bore you with that, but pay attention to what are the eligible categories. Renewable energy, that includes generation, transmission, and so on. We need to decarbonize our energy system, electrification being an example. Energy efficient, you think about refurbishing buildings to make them greener, energy storage, district heating, smart grids. Pollution prevention and control, including reduction of air emissions, greenhouse gas control, soil remediation, waste prevention, and so on. Environmentally sustainable management of living natural resources and land use. What does all that mean? Is a long sentence. This is sustainable agriculture, for example, which is very dear to my heart. We're working on a research report on sustainable agriculture as we speak. Climate smart farm inputs such as biological crop protection, drip irrigation, and so on. There's a lot happening and a lot of interest in sustainable agriculture. In particular, Canada, being a huge producer of wheat and soy and things that are not only consumed locally but internationally. Next category is terrestrial and aquatic biodiversity conservation, including the protection of coastal, marine, and watershed environments. Clean transportation, electric vehicles, hybrid, public rail, non-motorized multimodal transportation, infrastructure for clean energy vehicles, and reduction of harmful emissions. Sustainable water and wastewater management, that includes clean and drinking water, wastewater management, and so on, drainage systems. And I'm almost done. There's three more. Climate change adaptation. And that includes the efforts to make infrastructure more resilient to impact of climate change, as well as information support systems such as climate observation and early warning systems. So adaptation means what can we do now knowing the damage that we already made, right? These storms, how do we prepare for floods, how do we prepare for fires and all that. And then circular economy talks about production technologies and processes such as the design and introduction of reusable, recyclable, and refurbished materials. And this is across the value chain, not just a recycling bin, but can you reuse some of the materials in manufacturing, for example, improve your processes such that we're end up with the ultimate product that is cleaner than the previous one. And then the last one is green buildings that meet regional, national, or internationally recognized standards or certifications for environmental performance. So I'm almost at the end. Who are the issuers? We already talked about that, but I would say the recent Government of Canada bond, 5 billion, as Roy mentioned, 11 billion, so substantially oversubscribed, passes a very critical message. And having a Government of Canada green bond issuance not only helps investors invest, but also helps create a yield curve of green bonds that other entities can use to price against when you're setting spreads. And then what's happening in Canada? So the first green bond, province of Ontario, we mentioned that in 2014. I'm not going to repeat that. The Canada Pension Plan Investment Board issued in 2018 1.5 billion. That was the first pension plan in the world to issue a green bond. And as you know, pension plans have investments across the economy. So how they deploy those proceeds in their own investments is very significant for moving the needle. And then CPP also issued its first euro-denominated green bond in 2019, i.e. addressing investors from abroad, which is very important that we bring that money into Canada to help us in the net zero run. So federal government, we already touched that, so I'm going to skip that one. And the value of the federal green bonds to be used to price or hedge other green sustainable bonds to establish the green yield curve, which is very important. And that's what the EIB was doing. What the EIB is issuing green bonds, they are establishing a green curve because they're rated AAA. So any other issues that come at a lower rating can be priced against that one. So it's a great reference. And then it also serves to educate financial markets by giving investors regular detailed updates on the green projects their money is supporting. So we expect that the reporting on those will be very tight, very comprehensive. And then Canada's green bond market, just to end, is relatively small compared to the market in United States, Germany, France, and China. However, like global issues, Canadian issues continue to increase steadily in size and frequency as investors show increase in demand for green bonds. So I'm going to stop at that. And I know that it is a lot of terrain covered, but it is very interesting dynamics in terms of the green bond market. And what I would hope is that eventually down the road, every bond issuance would be green. And then we didn't need to differentiate, just like I hope that sustainable finance will with time become finance, right? Regular finance should be sustainable. So I'm going to stop at that.
You're muted, Roy.
Thank you, Sarah, for that very concise presentation. I'll turn it right over to you now, Mitchell. So please go ahead.
Thanks very much, Roy, and thank you everybody for being here. I'm coming to you from unceded Algonquin and Anishinaabe territory, also known as Ottawa. And I'll declare myself as a conditional fan of green bonds in the sense that I'm rooting for them to succeed because we very badly need them to. But I will suggest that they're not there yet, and we need them to get there quickly. This is a timely topic, as I'm sure everyone on this call knows, so I won't belabor this for too long. But it's timely because there's an urgent need for financing for carbon reduction and climate adaptation projects. The International Energy Agency reported last year that there is no room for any new oil, gas, or coal projects in a 1.5 degree world unless they are abated by carbon capture technologies. And those technologies, again, as many of you know, just looking at the participant list, many of those technologies still depend on lavish government subsidies, and they haven't been proven at scale. Last month, a peer-reviewed study led by Oil Change International found that 40% of the fossil resources now under development around the world have to stay in the ground to give us even a 50% chance of staying within the 1.5 degree guardrail for stabilizing the worst effects of the climate emergency. And that 50% chance, as climate campaigner Bill McKibben might say, is like playing Russian roulette with 3 bullets out of 6 instead of 1. The Intergovernmental Panel on Climate Change says that we can only emit 10 more years of carbon at today's rates before we blow through the remaining carbon budget that will allow us to hold climate change to 1.5. And UN Secretary General Antonio Guterres described the first installment in the IPCC's science report as an atlas of human suffering. So that's all the context for suggesting that progress is good, but fast progress is what we need. There are a lot of good coherent commentary out there about how succeeding slowly rather, is just failing slowly because we need to move faster than that. The examples that I cited are just the leading edge of an avalanche of news and analysis, all of it pointing to the responsibility on governments, international financial institutions, business, and investors of all sizes to shift the trillions, not billions, to clean investments from dirty ones. We're hearing that we need a 7-fold increase in climate finance to get the job done, with a corresponding drop in the massive financial flows to fossil fuels. Sarah referred to environmental, social, and governance standards, ESG. It's one of the most important tools for getting the financial sector in line with climate goals, and there is a steady daily flow of news on that as recently as an hour and a half ago, and before I turned off my email for this session. But the definitions matter, and if we want to bring the big picture principles down into practice and actually get this done, we have to get the definitions right at a moment when the field is moving so fast in multiple different directions. Technologies like carbon capture and storage, small modular nuclear reactors, and even natural gas and LNG are making a play for ESG status, even though the first 2 are expensive and unproven, and the third is a methane bomb. Whether the fossil companies realize they're greenwashing is actually a more complex question than it might sound. With some companies, you can tell they're lying when their lips start moving. And again, I keep saying it, many of you know that. But I talk to people inside the fossil industry every week who are serious and genuine about emission reductions. They're looking for the best pathways to get those reductions done within their existing industry, because they really believe we'll need fossil fuel through mid-century. And generally, they don't have the expertise in the transition technologies, transition strategies, and modeling that are making oil and gas obsolete far faster than they realize, and far faster than today's prices might suggest. Sarah, you mentioned the Canadian Pension Plan Investment Board. Yes, they've been making some solid moves in their own halting way. They're also an investor in the second biggest fossil gas pipeline network in Italy. And last I saw, they were spinning that as a green investment, because after all, gas isn't coal, right? That kind of talk, that kind of strategy slows down the transition we need, and just as important, and unfortunately, just as I'm afraid I'm doing here, it undermines confidence that institutions either mean what they say when they claim that something like the gas pipeline network can, in this universe, be a green investment, or that they understand what they're saying. And I'm not deeply enough imbued in what CPPIB is doing to know which of those it is. But what I do know is that that kind of investment is not green. Much more often than not, fossil companies in particular might grudgingly measure the Scope 1 and Scope 2 emissions that they produce by extracting and transporting their product, but they don't acknowledge the Scope 3 or downstream emissions that occur when their product actually reaches its end user and is buried, is used as directed, and that accounts for 80 to 85% of the carbon in a barrel of oil. Nor do they talk about the abandoned wells, the downstream cancer clusters, the massive species and habitat loss, the destruction of indigenous culture and cultural sites, or the financial pain that they bring to local communities by refusing to pay their local municipal taxes after those towns, often many of them single industry towns, have become dependent on the revenue. And when we write that story in the energy mix, we just refer to them as deadbeat fossils because we're so mature about it, but that's what they're doing. They are deadbeat fossils, not even bothering to pay their local taxes. Too often we see trade-offs between the E, environmental, and the S, social, in ESG, with governments and businesses triumphantly declaring indigenous fossil fuel projects as a pathway to reconciliation. I've also heard those projects described as 21st century smallpox blankets, because when oil prices crash again, and we know they will, and the projects fail, and we know they may well, 40% of them have to stay in the ground, First Nations will be left with the stranded assets and the pollution that results. In British Columbia in particular, support for those projects often comes from elected councils, not the traditional chiefs who actually have authority over lands outside the Indian Act Reserve system. The elected bands often accept the trade-off because they have no other economic opportunities, and that part does fall within their responsibility. But other communities have found a different path, with the Indigenous Clean Energy Organization pointing to 197 projects now underway, and that number itself is now almost half a year old. So we should look ahead and look forward to the day when green bond money starts consistently moving in that direction, instead of a lot of the money that is still going into fossil investment with a green hue. Even when companies do measure Scope 3, they can get a great score while delivering goods and services that make things worse. Think of a military contractor with strong climate performance whose products destroy lives and infrastructure when used as directed. The elephant in the room and the elephant in every mutual fund portfolio is that it isn't just about how they operate. It's not just about the process. Sometimes it's also about what they're in business to do. We are seeing some evidence that Canada will fall behind other industrialized countries if it fails to fully factor these deeper, bigger issues into its ESG accounting. The European Union is on track to exclude natural gas and nuclear from its green investment taxonomy. That decision is due next month. And we're starting to see a really interesting disconnect in the talk about Canadian gas exports to help Europe free itself from Russian supplies. While investors are looking for long-term gas supply contracts to make those deals profitable, Germany, for example, is saying it won't need any gas beyond 2044 when it's committed to being essentially fossil-free. The world is changing fast, but you won't hear that from our very ESG responsible fossil fuel CEOs who expect to continue increasing production at least through 2032. So much of this comes down to trust in all directions, and that's something that has to be earned in all directions, not legislated. I've been told that the kind of argument I'm making here comes across as an attack on the fossil sector, and I can see why it feels that way. I can understand how uncertain it feels to try to transform a whole huge industry while still meeting payroll and still staying in favor with investors who are still thinking of ESG as a PR statement, not a strategy map. They're still thinking of it as something that comes out of the communications office, not the project management office. And that difference matters so much. But what you're hearing here is based on science, not ideology. And we can only afford for ESG or any other investment strategy to support business ventures that do match up with that science, without relying on technological unicorns like carbon capture and small modular reactors that the industry itself is still unwilling to invest in at the scale that they would need to make them work. There is a whole other equal and opposite narrative that we hear all the time in Europe and even the United States, but so rarely in Canada. Earlier this month, Corporate Knights published its first ranking of the Future 50, the fastest growing green and clean tech companies in Canada. The list includes battery makers, one battery recycler, an electric school bus manufacturer, green hydrogen companies, plant-based food makers, as well as some carbon capture startups. Not all of those companies will succeed. Corporate Knights wasn't trying to pick winners, and we certainly shouldn't be trying to do that here today either. But the listing really brought home to me that mainstream finance in Canada, and I hate to say it, even sustainable finance in Canada, too often does pick winners. They do it every time they ignore or de-emphasize clean tech in favor of carbon capture technologies that still aren't proven at scale, blue hydrogen schemes that aim to use those unproven technologies to make natural gas a slightly less explosive methane bomb, or small modular nuclear reactors that aren't small at all and mostly still exist only on PowerPoint slides, not in detailed engineering drawings. Last point is that we've recently seen Russia's war in Ukraine financed by $97 billion to date in fossil fuel revenue, shifting the focus and the lead argument from energy transition from emissions reduction to international security. And I think that's fine, as long as it delivers the momentum we need. This morning, the REN 21 Secretariat reported that renewable energy growth is stagnating after countries missed a huge opportunity for a green recovery from the COVID-19 pandemic. By contrast, European countries are making it very clear now that they need short-term relief to stop Vladimir Putin from leaving them literally freezing in the dark this winter. But that experience has brought home to them that they need to get free from all fossil fuels from any source, anywhere, ever, and quickly. We'll all want to attend some future webinar on what it says about humanity, that it took a brutal war to get a leading economic bloc more clearly focused on emission reductions. But however we feel about the motivation, that change is happening as we speak. And it's in Canada's business interest, as well as our economic, environmental, and social interest, to make sure that we catch up and keep up. Roy, I hope that was close to the 10 minutes.
Mitchell, thank you so much for your passion and your dedication to the truth and to also reduce emissions reductions and get where we're going to go. I'd like to invite Sara, if there was anything in Mitchell's remarks that you would like to pick up on, either by way of criticizing it or in fact supporting it. Are there things on which you would agree?
You know what? As I was hearing you speak, there's quite a number of points that we pointed out in our Changing Gears report. That was a publication where the ISF looked at the 15 recommendations of the expert panel, which were made about 2.5 years ago, and what progress has Canada made with respect to those recommendations. So yeah, the conclusion on that report, which was quite extensive, 34 people from the market were interviewed across Canada and from different perspectives. The conclusion was we need to step up our game. We need to do more. So from that perspective, I think we're both aligned. We have another report, the TSX reporting, and the TSX report looked at the companies listed on the Toronto Stock Exchange and looked at what they were reporting in terms of GHG emission reductions, but importantly was also looking at any disclosures on their targets and any disclosures on links to compensation, right? To see how serious, what kind of action. I mean, linked to compensation, not everything, but it helps. So that report was issued last year and again was refreshed a couple of weeks ago to see if there was any progress. And as expected, many more companies are now talking about targets or some level of targets. Now it is up to the market to track, are those targets being delivered? Are they on track? Are they just issuing targets out there? And there's a wide range, right? A lot of companies are actually looking at this seriously and strategically, having plans in place. You know, they have groups and teams dedicated to it. Some others not so much so, but in any event, I think the current work of the International Sustainability Standard Boards on setting standards for reporting is the genesis, is the starting point. How can you invest? How can you have this conversation if company A, potentially in very good faith, is reporting XYZ and company B is reporting ABC, just simply because that's the data that they have access to, those are the records that they have, that is in their, best belief what they need to be reported. So they make that determination. We need this to be standardized. And that would put everyone at the same level and also make it very easy or easier to investors to be able to compare what companies are going. And importantly, I know a lot of the pension plans, a lot of the insurance companies and investors are engaging with companies. You have Climate Action 100, you have similar group in Canada, which have taken the position of not dispose, because you dispose and you're not at the table anymore, but engage. Ask the right questions, what are your plans? How are you going to get there? Are they happening quick enough? And so on. So depending on the strategy, right? Some entities are, looking at disposing of some of their assets and rebalancing. Some others are engaging, but I think a combination of the two is what we have seen more predominant. So, on those points, I think we are fully in agreement. On the technology opportunity, I think we disagree on that a little bit. Maybe we don't disagree, but maybe it's a different perspective, because I believe that Canada is a leader in technology, and a lot of these new technologies may help in the transition and in the decarbonization. Just, little changes here and there. With this massive change of infrastructure. I worked on infrastructure investments for many, many years. I've been in business for 33. I have my helmet there to prove it. It is, these projects, when you look at cost benefit analysis, when you look at, putting the project in place, then you go through the procurement process, then you procure for the start of operations, right, which is when you really start decarbonizing. It takes years. And depending on the sector, if you're looking at nuclear, 20 years. If you're looking at some of the others, maybe hydro, maybe, less than that, but still many years, right? And it is that luxury of time that we don't have. So we need to make sure that we accelerate in whichever way we can. And I am a big believer that technologies, not all of them are going to be successful. I don't want to talk about specific ones, but I think technology could change the game and help us accelerate this. Go ahead.
So no, I don't want to interrupt. Go ahead, sorry.
At the last point that I picked, you said transition, and I think that is a key point. If we were to say, let's switch, boom, zero oil and gas today, my house will freeze in January and I won't be able to drive a car. We need to make sure that transition, we're talking about the supply side, but we also need to talk about the demand. The day that there is no demand for oil and gas, there is not going to be any demand, right? So on that perspective, on the transition, I believe that is going to take a little while. It's going to take the effort of everyone. It's not going to be an easy road. We need to all come down to the table, but it's not going to happen tomorrow.
Okay, so first of all, I think it's okay to disagree respectfully. To your point, a few of your points. First of all, I don't hear anybody suggesting that we're going to go to zero tomorrow. And I'm not suggesting you're doing this, but when, that is the red herring we hear from every fossil CEO and from the Canadian energy regulator when they try to justify that we need to increase production through 2032. So it's not that we're going to go to zero tomorrow, but if that's the direction of travel we know that we need and want, and if we're hearing from multiple authoritative sources that we at least can't have any new production, we're not getting the job done if we're not taking that seriously. And green bond or any other financial standards are not helping us get the job done if they don't clearly, consistently, rigorously drive in that direction.
And on that point,
to your point, I mean, if we had time, all of what you're referring to is positive. It's to the good. It's somewhere in the range between well-intended and well done, and that's all to the good. If we had 30 or 50 years, if we had a couple of generations to get this done, which of course if the time scales are possible, industry wants, because they want to keep extracting every last drop.
Yeah, and
fair enough, that's their business, but we don't have time. We have to hit 50% by 2030, and we're running out of time. So if you're looking for technologies, and although I don't think technologies are the only solution, we agree that is a fundamental building block of what we need to get done. If you're looking at technologies, and you have a choice between technologies that are practical, proven, and ready for prime time, or technologies that are still not ready for commercialization. If you have technologies that are affordable versus technologies where the industry is still not willing to get out of bed and start work after billions, not millions, of taxpayer subsidies on offer. You referred to the total amount that's been done in green bonds in Canada so far. If I heard you correctly, more than that is on offer just to subsidize carbon capture technologies that are still not proven at scale. Whereas on the other side, we could use that money productively to conduct mass deep retrofits on every home and commercial building in Canada by 2035 or 2040, create more jobs, frankly, than we know how to fill right now. The training is one of the biggest challenges in this. Put an end to energy poverty once and for all. But, sorry, if we do that, we'll be destroying demand for fossil fuel companies. Gas companies won't be able to handle it because they'll have nothing to sell. Well,
no, but what I'm saying is the demand that will drive the bus, right?
So
it is
drive
one
it down.
guy.
So invest in driving it down. Don't invest in new supply when what you're saying you want to do is drive down demand.
Yeah, and when you're saying, CCS and not proven and all that, I didn't refer but wait a second. When I refer to technologies, I'm talking about technologies across all sectors of the economy, right? You're focused on one, CCS, technologies in general. And I think that's where we can make a huge difference. I mean, technologies on, buildings, technologies on clean water and so on. That's when we can not only make it a little easier for Canada, but we can export those, right?
Yes.
And help at a global level. So that's the technology angle that I was taking. When you say new oil, I'm not supportive of new oil, just to be clear. But on the transition side, I don't think that we can switch the switch tomorrow. And I think on that, we both agree.
No.
Now, on the transition side, when you're looking at how do we get out of this when we're a resource-based economy, right? It is trying to figure out what can we do through the transition to achieve those goals that are going to get us to where we need to be in 2030 and then 2050, right? While at the same time, you continue running your economy and heating your homes. And that's it is very difficult. I'm not arguing that it isn't, right? And we don't have time and we need to react very quickly. And that's what we have been saying. At the ISF, that's our point, right? The more we get policy at the table, the more we get investors at the table. Actually, I wrote an article on LinkedIn saying that we need to be multilingual. And I'm referring to understanding policy, technology, and finance and sustainability, right? So it is the four that people need to navigate. I speak finance. Some people speak more policy. Some people speak more technology. And some people are very, very knowledgeable on sustainability. We need to get those four conversations at the table because everyone will need to contribute if we want to move forward. And what I find is if we have, people on this end and people on this end, we need to perhaps get here to get moving because it is very important that we start moving very quickly. We have another report that we called, it was one talking about how much is it going to cost to decarbonize. And we arrived at, the largest sectors were energy, transport, buildings, and then agriculture. And it is those that, if that's the biggest impact for every dollar invested, then we should focus on, obviously those as opposed to one where you don't have that efficiency ratio. So I think, it's very challenging. I don't disagree with you, but I think we need to keep in mind the transition part of it and the need for everyone to come to the table and help the process.
Okay, if I can interrupt, this conversation will go on for the next hour or two, I'm sure, but we have a number of questions in our queue. A couple of very short factual ones, which I direct to Sara. From Sara Alvarado, do green bonds have to offer a higher yield than regular bonds? And Abin Abraham, who asks, do green bonds have higher yields? So, Sara, can you dispose of those two questions?
Higher yields is relative, right? What are you comparing it to? And then if you look at the traditional risk return, right? That's what you're looking for. You're putting your money in and you're expecting a return. If you're an insurance company, what you're doing with that investment is you're counting on those cash flows to match your liabilities, i.e., your insurance and my insurance, right? Your life insurance and my life insurance. Do I want these people to risk that unnecessarily? Do I want them to take care of that investment because they're going to need to pay our life insurances when we die? Hopefully not yet. But anyhow, same with pension plans, right? They are investing this pool of money from our premiums so they can pay us when they retire. And I hope I can see my check. So, it is that fiduciary duty that we need to keep in mind. So yields are related to the risk of the bonds, right? So they typically come with a rating. Now, you have credit rating agencies, and now you have environmental rating agencies that are giving them a rating, but not necessarily. But I would say people look at the risk, and are people going to give up on yields, specifically, when you're looking at larger investors for contributing to, that's the challenge, right? When you're building a portfolio, you want to make sure that you maintain your threshold. If you're looking at a fund, for example, that you maintain a certain yield that you need to provide investors while you're managing the footprint of the portfolio. And, when you look at Government of Canada AAA, I mean, you can track the yields, right, and see how they do versus the non-green market, but could or could not, depending on market conditions, right? Now, if there's huge demand for green bonds because everyone's trying to decarbonize their portfolio, it could be not necessarily the credit component of the bond, but the supply-demand component, right? Okay. I hope that answers the question.
I think that's a great response. I'd like to move on, though. There's a question which I think both of you should have a go at. Is there any form of overhead or external oversight to ensure that green projects are actually doing what they say they're trying to achieve? Or do we have to rely on the data and reporting the projects are presenting without assurance that the data and reports are, in fact, a real picture of what they're doing? I think, Sara, do you want to start on that one? And Mitchell, if you have any comments.
I think that's a excellent question, and I welcome it. It could have been a planted one from me, because I think that's the work that the ISSB is precisely working on right now, is standardizing those disclosures, right? So that the market knows what's going on and that they know it on a standard basis. That when they read this report from one company and that report from that other company, that they know that the process is standard and that it's been verified. So when you look at the ISSB, and I know it is an alphabet soup out there, ISSB is under the IFRS. IFRS is for International Financial Reporting Standards, is the accounting, right, that we follow in Canada and in Europe, by the way. So when you look at accounting, we have rules for how do you disclose your P&L, what do you disclose in your footnotes, what do you do with your expenses, and so on, accruals and all that. And that is standard across all industries, right? Well, the same with sustainability, right? It should be standard because it has a huge impact at the end of the day on enterprise value of a company. If you're not doing what you're supposed to be doing, if your products are not competitive globally, if your employees are not, treated according to labor laws and so on, sooner or later, this is going to transpire right in your price. So at the end of the day, enterprise value, and this is something that in the past we had been looking, is the company well managed? Who is on the board? Are they making good decisions? Those things have been asked for in the investment community. Now we're introducing the ESG component into the formula. So, every factor that you put into a formula makes it a little bit more complex. But I find the work that the ISSB is doing in standardizing it globally, and let me emphasize it globally, right? Because money flows globally. So for somebody from Europe to understand what Canadian companies are disclosing and vice versa, we have our pension plans invest internationally, right? So they want to make sure that those disclosures are comparable. And I think that's going to change the game. And consultations are ongoing. The SEC is also have ongoing consultations, and also the Europeans. And they all tag to TCFD, the Task Force for Climate-Related Financial Disclosures, but there are some differences how they account for Scope 3, for example, Scope 3 emissions, and so on. But there's a lot more similarities than differences.
Okay, Mitchell, are we doing enough in terms of disclosure and reporting, notwithstanding the ISB, which sounds like a great idea?
Well, I very much agree with the points that Sara just made. That's refreshing. We agreed. But actually adding from something that you said earlier, your reference to how we all need to be multilingual, I think that's just a perfect, brilliant way of framing it. Because I think one of the challenges we've seen in our on or off record interviews with financial professionals at different levels, is that there are those four categories, and I won't be able to run them off, but they landed when you did. The sort of the four different categories of knowledge and expertise that have to come together in this, and add to that complexity our back and forth a few minutes ago about technologies, that there are multiple different pathways, options, possibilities, sectors where all of this happens. And I have a lot of sympathy, certainly with frontline analysts who are trying to sort all that out and figure out for themselves, okay, so what's green today? That may or may not have been yesterday. And I know I'm going to have to do this assessment tomorrow. And by the way, this is just 10% of my job. What am I supposed to be doing here? So yes, all of those things have to be factored in. Because otherwise, the whole system, as we're seeing today in real time, is so vulnerable to greenwashing, either deliberate or not. And I do think that's suggested that it comes in both varieties. That anything, just about anything, can try to make the case for being ESG compliant. The new standards, thankfully, are intended to address that, but to get at that, they'll have to be as complex as the real world they're operating in, and that's necessary and a challenge, and we shall all be rooting for that to succeed very fast.
And you know what? Great point. And you know what? One thing that we're looking at, when you mentioned the analyst, looking at what do I do now? A big component of the whole formula also is education, right? And that's what we're trying to do with this sustainability course, is to bring it down to reality. Okay, this is your portfolio, Mitchell. How do you keep your return so you can retire and at the same time lower your footprint, right? Because, is that kind of like, thought process that asset managers are going through, but also the education portion, right? Because people are going to be very knowledgeable on either one of the four, but, talk to a policy person, they're typically not necessarily technical experts, right? Or technology experts. But there's a reason for why, right? We want to have the expertise, but I'm pointing to the collaboration and this type of conversations needed, right? The more we have the four components at the table, the better and the faster and the more efficient the initiatives are going to move. So to the point on the analysts, they're going to be very strong on finance, but they need to keep their eyes wide open as to what's happening out there on the other three.
And once again, I'll just
go ahead. Go ahead.
Thank you. Quickly make a pitch for yes, all of that, and there are the two paths, the two tracks. We know that the four categories are going to be addressed in the context of our future is CCS and blue hydrogen and small modular reactors, because there's an industry fighting for its survival to have the resources of the five. And on the other side, we will have, small but mighty, small but feisty energy efficiency and renewable energy companies that don't have the resources to balance that have a better product that is more ready sooner and can deliver more better without frying the planet when used as directed. So as we pursue those four categories, and I'm sorry to somebody in the, in the chat who said there's been one reference to green bonds in 15 minutes, here's another one, because this does apply to green bonds. We need those four categories, but they also, if they're going to be streamed to the legacy technology stream that is entering at sunset, and we know it will be, it also needs to cover the options that will actually give us the alternative to that, or the system won't get as far as it needs to get as fast as it needs to get there.
Okay, I just wanted to touch on a couple of the questions before turning it back for final remarks, a very brief sum up on the part of each of you. Letitia Charbonneau has asked a few questions, but the one I'm going to settle on is, what does it tell us that my pension fund, Ontario Teachers, has a green bond offering in Europe, but not in Canada? Sarah, you want to have a go at that?
You, as an issuer, what you do is you try to diversify your sources of funding, right? And that's happened all along, right? So aside from the green bonds, I don't know if they do, but I'm pretty sure that they would have issuance in Europe that are not necessarily green bonds, but regular bonds, right? And what you do is you try to diversify your sources of funding. If you're a big issuer, Ontario, for example, they have had US denominated bonds for the longest time. They were not green, regular bonds. So you try to diversify by currencies, diversify by countries or jurisdictions, and you also try to diversify by terms, right? You don't want to be dependent on having to refinance one bond in 5 years with one area, right? So I think that helps. And I just mentioned at the beginning that the EIB had issued in 17 different currencies. And I think the EIB came to Canada with a Canadian issue. So that's the reason why, right? They try to diversify their sources of funding.
Okay, here's a question from Alan Slavin. The green bond offers that I have seen all seem to be aimed at institutional investors. When will we see green bonds aimed at individuals? Is this a good idea? Sarah?
That they are purchased by institutions but not by individuals?
I think that's the implication of the question.
I just bought 3 weeks ago Ontario green bonds, precisely for a little bit of higher yield than the Canadas. So
the Canadas are also available to individual investors as well. Correct?
If you go through your broker, I used my broker and then I went through that channel and I was able to purchase Ontario green bonds.
Okay, here's a question that's a bit more general. How to make the green bonds flows consistent with a pathway toward climate resilient development across the globe? Mitchell, do you want to have a go at that one?
I think we've been, thanks for the question. I think we've been covering so much of that ground in the course of the hour. Maybe the one thing I would add or just emphasize is that so many of the options that take us into that next economy are also the least cost options. And they are the options that create the most jobs, that put most of the wealth, that put more wealth into a wider range of communities, that reduce so many of the environmental and social problems that have come along with, let's acknowledge it, the benefits that we've all taken away from the fossil fuel economy.
Okay, Sarah has to leave at 2:00, so we're going to respect that hard ending for the webinar. So I'd ask each of you now in the next minute or minute and a half to give us your one or two principal takeaways from this conversation. So perhaps Mitchell, we'll start with you.
I guess what I'm really taking away from the conversation is both the urgency and the complexity. It's not an easy thing to do. We've got ourselves, all of us as a society, into a place where time is limited, and we need to get this done. Very much take the point that you've been making, Sarah, that this isn't going to work, and nor should it if it means asking people to give up their returns and give up the security we're all looking forward to and hoping for in our latter years. And that security will also be increasingly undermined by climate risk, climate disasters that are accelerated every time something labeled green or not is invested in products that accelerate the emergency when used as directed. So ultimately, we have to be able to balance both. And I guess all of us watch this space because I don't think the conversation will end soon or necessarily soon enough.
Thank you, Mitchell. Sarah?
Yes, and thank you. As I said earlier, this road is not going to be an easy one. It's challenging. We all recognize that. I also mentioned that there are things being taken place and then some progress, but we need to do more. And that was our conclusion on the changing gears. Some progress has been made, but we need, because the challenge is so enormous, right, that we're, making some progress in some areas, but we need to make more progress. But what I would say is I look at individuals, I look at the corporations, I look at government. Each one has a part, right? Government will deal with the policy side, institutions will deal with the investment side and the engagement side, and they're doing that as we speak. Us individuals can do something, right? And then it would be for us to educate ourselves. We have at the ISF, self-promoting here, but we have a lot of research that is free. All our webinars are for free. And we have a primer on green bonds. We have a primer on fiduciary duty. We have, I think, 17 primers or so. We have a number of research reports available in English and French that are available for free. for you to get a sense. And it is up to us, and I'm talking of individual investors, to educate ourselves, right? Look at what's available, participate in conferences such as this one, and importantly, direct your money towards sustainable projects, because, the collective investment of retail can make a huge difference for Canada.
Okay, well, with those remarks, let me draw this conversation to an end. And I'd like to underline Sarah's reference to her primer on green bonds on the Institute of Sustainable Finance website, because there was one question which suggested that we should have learned more about green bonds. Well, there's a lot to learn about green bonds, and so I'd recommend going to the ISF primer that Sarah has suggested. And I'd like to thank both Mitchell and Sarah for their remarks, for their insights, for their advocacy, and for their dedication to what we all want, which is a sustainable climate and a just and equitable world economy. And I think green bonds may have a very small part to play in those kinds of agendas. I'd like to thank all of our questioners who, and I'm sorry that we didn't get to all of the questions, but there's some excellent questions still in the queue. And finally, I'd like to thank Sarah Bowles, Executive Secretary of the Group of 78, for helping to set things up for this Zoom conference. Thank you all again. Take care, and please stay tuned for more. Thank you, Sarah.
Thank you. A pleasure. Thank you all.